Welcome to another Southbank Investment Bulletin. Here's a chart of the UK CPI. So we can see that it peaked at the end of last year and it's down to less than 8%. That's still a long way from where the peak in inflation was back in 2008. If you remember back then, oil prices were surging and everyone was worried that there was perhaps a new inflationary trend. And now we've had a massive spike in inflation in the aftermath of the pandemic, and it's only just beginning to come back down. But let's just think about what are the things that contribute to inflation. Well, the first would be wages. And we are seeing that there are strikes left and right around the UK. And then we can think about the wage demands that are occurring. Well, people have secured wage demands, but inflation is only just beginning to come down. So the net is that people have seen a big decrease in the net wages that they have, but that is totally dependent on inflation coming back down. That doesn't mean that prices are going to decline. It simply means that they'll stop going up as quickly. But what happens if inflation spikes again? Well, I think that's something that we really do need to pay attention to, because something that we certainly know of is that the price cap for energy is about to ratchet higher. So that's obviously going to increase the cost of electricity for a lot of people. Now we also have the fact that oil prices have broken their downtrend. So Brent crude is now up to $86. But it has been trending downwards for the last 18 months. So now that we're starting to see prices rising, well, that is probably then going to also contribute to inflationary pressures remaining sticky. So the Bank of England is beginning to think about the peak of the interest rate cycle, but whether they're going to actually be able to stop raising interest rates is going to be very dependent on the trajectory of inflation. And there's quite the possibility that we're going to see inflation remain higher than people were expecting for a while. So the best way to monitor how the market is really thinking about that remains the gilt market. And the 10-year gilt yield is right now around the 4.5% level. That's very similar to the level on the 10-year Treasury yield in the USA. And yields are starting to come down. Now, there are two reasons why yields would come down. One would be inflationary pressures are coming down, and the reason for that would be that inflation is the risk-free rate. Bonds are the risk-free rate. Inflation is what eats into it. If inflation is coming down, well, then your risk-free rate is more impressive. So you would buy bonds if you thought inflation was coming down. But you would also buy bonds if you thought there was a recession coming. And I think that is one of the big issues that we have, is that if oil prices surge higher, it's going to put pressure on consumers. And if consumers can't afford to buy goods and services, well, obviously then economic activity is going to get hit. That might be part of Russia's decision. What they're trying to do is turn the war in Ukraine in their favor. And putting pressure on the supporters of Ukraine is about the same as putting pressure on Ukraine. If they decide to curtail their oil exports, that's going to put upward pressure on oil prices. It's going to make the lives of everybody in Western Europe and North America, and Australia for that matter, feel a bit more difficult. And it could also potentially, I guess, be aimed at trying to influence the US election. One thing we can just think about, if anyone really needed any proof that oil prices are important to US politics, well, last year, Joe Biden basically tried to influence the midterm elections by releasing a massive amount of oil from the strategic reserve. Well, there is the real possibility that Putin might decide to curtail oil supply in order to influence the presidential election, something certainly that we need to pay attention to. Now, when we think about the broad UK market, the FTSE 250 is the most common way of looking at the domestic market. It has rebounded from the 18,000 level and is now at the first area of potential resistance. And this area is going to test the resolve of the bulls. If it can sustain a move up through 20,000, then we're back in a medium-term recovery environment, and prices have been ranging mostly below the 20,000 level for a year already. So if it can sustain a move up through that level, that would be quite positive. The resilience of the UK stock market is going to be dictated by, or at least influenced by, what happens with the pound. Now, the pound got up to test the 130 level versus the dollar, and it has eased back. But the dollar has begun to also weaken, and that is at least in service to the possibility that US growth is going to weaken further. But because the US has been stronger than most economies over the last year, any weakness there would contribute to weakness in the US dollar. And the pound is back testing the region of the sequence of higher reaction lows, so this is a potential area of support right here. And UK valuations trade at a significant discount relative to the USA. Now, part of the reason for that is because of some of the unique challenges that the UK economy has, and that has been, I think, adequately discounted in the UK stock market. Any improvement relative to the USA will start to move funds in there, and it could easily outperform. So it's certainly something to pay attention to, and if the pound can rally, then that will also help to attract investor interest. Now, with the potential for the dollar to roll over, gold began to steady again in here on Friday. And that was a very small upside key reversal. Now, the key to a key reversal is size. So we would need to see significant upside follow through in order for that to be a signal that we could really hang our hats on. But at least we're starting to see some steadier action in here. Now, when we think about how that is playing out for the pound, or for gold denominated in pounds, well, it's been very inert for the last couple of weeks. It's still ranging here below the 200-day moving average. If the pound continues to firm here, well, then that will probably contribute to gold not performing quite as well in pounds. But it's only a matter of time before we start to see gold move up the rankings in terms of performance for global monetary measures. When we think about the potential for the global economy to slow down if oil prices surge from here, then every currency will take a hit and gold would become more attractive. So I'd still remain of the view that this is an attractive area to start thinking about physical positions in gold. I think it's an interesting place. And if the trend were to break, well, then we're sufficiently close that it would be pretty obvious pretty quickly. So I think as we look ahead, there's a lot of moving parts in the global economy right now. Nobody has any direct experience with inflation in the recent past, and we're all learning as we go. But one thing that we know from the 1970s is that inflation came in waves, and there were certainly surprises. And the one thing that really moved prices and got everybody panicked was the oil embargo. So I think everyone should be sensitive to any potential risk of another embargo, this time not from the Middle East, but from Russia. And I think with that, I'll leave you for this week, and I'll wish all the best to all of you.